For like ever, lending has been built on this one simple rule: no credit history, no credit. It's a system that has, well, locked millions of people out of basic financial services. But what if there was another way? What if you could figure out someone's creditworthiness without ever looking at a traditional credit score? Well, today, we're going to crack the code on a fintech revolution that's doing exactly that. So to really get a sense of how big this problem is, let's take a look at a country like Mexico. Just 12% of the people there have a credit card. Now think about that for a second. That means the overwhelming majority of the population is what we call credit invisible, totally outside the formal system that so many of us rely on. And yeah, that brings us to the multi-billion-dollar question that has just stumped traditional banks for years. How in the world do you assess risk? And more importantly, unlock the potential of this absolutely massive underserved market? That's the core problem we're going to tackle in this explainer. Well, the answer, it turns out, isn't found in a bank vault. It's hidden in the digital breadcrumbs that we all leave behind every single day. Every time you order food, pay a bill online, or subscribe to a service, you're telling a story about your financial habits. The real breakthrough is finally learning how to read that story. This is what the industry calls alternative data. It's basically everything that traditional credit bureaus just ignore. We're talking about really simple stuff, paying your utility bill on time, that Netflix subscription you never miss, or even how you use a food delivery app. These little actions might seem small, but together, they paint a really vivid picture of financial discipline. Now, here's where it gets really interesting. Not all this alternative data is created equal. On one side, you've got static data, your digital footprint. Think of it like a single snapshot in time. The kind of phone you use, your email provider. It's useful, sure, but it's limited. But on the other side, you have dynamic data, your actual digital transactions. This isn't a snapshot. It's the whole feature film of your financial behavior. It shows what you buy, how often, how much, the whole story. And that leads us to the most important point of all. According to a landmark NBER working paper that studied a fintech lender in Mexico, the single most powerful tool for predicting creditworthiness is this rich proprietary transaction data. It's the crown jewel. Why? Because it tells that continuous story of financial habits that a simple, old-school credit score just never could. So just how powerful are we talking? Well, a machine learning model that was trained on this data, for people with zero credit history, mind you, achieved an AUC score of 0.791. Now, for those of you who aren't data scientists, let me just say that is an incredibly high score. To put it in perspective, anything above a 0.7 is considered great, even with tons of data. To get a score this high with a credit invisible population, well, that's a massive leap forward. And check this out, the model literally gets smarter with every single transaction. Its predictive power just keeps growing as the data gets richer. So for users with just 1 or 2 transactions, the score is already a respectable 0.742. But get to 29 or more transactions and the accuracy just skyrockets to 0.828. It's a perfect illustration of a simple truth. The more of your financial story the algorithm can see, the better it gets at understanding you. Okay, so we've established that this data is, well, it's unbelievably powerful. But that just leads to an even trickier question for lenders. Now that you can predict behavior so accurately, what behaviors should you actually be trying to predict? And this sets the stage for a really fascinating duel between two totally different algorithmic philosophies. So, let's meet our two contenders. In one corner, you got the default model. Its goal is simple, it's traditional, just minimize risk. It asks one and only one question: is this person going to fail to pay me back? But in the other corner, we got the profit model. It has a much more modern, bottom-line goal: maximize profit. And it asks a very different question: is this person going to be a profitable customer for us over the long haul? So, who do you think wins? The cautious, risk-averse model, or the ambitious profit seeker? It seems like a pretty obvious answer, right? But the result of this showdown is where this whole story gets really counterintuitive. All right, let's get to the climax of our story. This is where we put these two models head-to-head using real-world lending data and just see what happens. And I gotta tell you, the results, they challenge some of the most fundamental assumptions in the entire lending industry. And here is the twist. After all that complex modeling, the study found that both algorithms, the one trying to avoid defaults and the one trying to maximize profits, they end up generating almost the exact same amount of total profit for the lender. From a statistical standpoint, there's basically no difference between them. So, how is that even possible? Well, this slide shows the two very different paths they take to get to the same destination. On the left, you see the default model's profitability.
It follows this kind of inverted U-shape. As the risk of default goes up, profits rise, but only to a point, and then they fall off a cliff. The model's whole job is to stay away from that cliff. But the profit model on the right is way more direct. It's just designed to find the borrowers who sit at the very peak of that profitability curve. They're getting the same result just by looking at the problem from two different angles.
This matrix is fantastic because it shows us exactly where those two paths split. The models agree on most people, right? Almost 60% of applicants are approved by both, and about 28% are rejected by both. But the real story, the interesting part, is in the disagreements. You've got this 11.3% of people who are approved only by the safe default model, and then this smaller, much more interesting group of about 3% who are approved only by the profit model. Okay, now let's zoom in on just those two little groups where they disagree. And this is fascinating. The people approved only by the profit model, they have a much higher default rate. We're talking 28% versus just 17% for the other group. So by definition, they are way riskier. But, and this is the absolute key, they generate 1.6 times more interest revenue. The profit model is making a very calculated gamble. So here it is, the secret sauce. The profit model actively seeks out and approves riskier borrowers. It identifies people who are likely to carry a balance and pay a lot of interest, but hopefully, just hopefully, not default. It's walking a financial tightrope, trading that higher risk for a shot at much higher returns, while the default model just wants to play it safe. So what does all of this mean for the future of finance? I mean, this isn't just some academic exercise. This has profound implications for how credit is accessed and managed all over the world. Let's break down the key takeaways. First, and this is huge, this technology can dramatically expand financial inclusion. It can bring millions of credit-invisible people into the formal system. Second, it creates incredible market power. Lenders who own this proprietary transaction data, think of a delivery app or a big e-commerce platform, they have a massive, defensible advantage. They've essentially built a data moat that traditional banks just can't cross. And third, all of this highlights an urgent need for new regulations, like open banking, to try and level the playing field. And you know, the researchers themselves make this point directly. They argue for open banking policies that would empower you, the consumer, to take your data from a delivery app or an online store and share it with any lender you choose. This would break open those data silos, increase competition, and ultimately give a lot more power back to the individual. And that brings us to our final thought. For any executive or business leader watching this, the rise of AI in lending presents a really fundamental strategic choice. The question is no longer just, can our algorithm predict risk? The real question is, what do we want our algorithm to value? Are you building a business that prizes safety and stability above all else? Or are you building one that strategically and intelligently embraces risk in the pursuit of higher profit? The answer to that question is what's going to define the next generation of financial services.